2022 has seen one of the worst crashes in bond funds ever, and it's interesting that when that happens to equity, people say you should buy it because it's a bargain, but you never hear that about bonds. So in this video, we're going to look at 2 reasons why now might be a good time to buy bonds and 2 reasons why it might not be. And also I'll talk about what I'm doing in my own fund portfolio. So let's look at the bond crash and whether it's now time to buy bonds in a bit more detail. Let's begin with the reasons for and against buying bonds. Starting with the reasons for buying bonds, I think the first one is that we might get a US recession. Normally that's a good environment in which to buy bonds. Remember, bonds feed on economic misery, whereas equity feeds on economic joy. So if there is a recession, that's usually good for bonds. The second reason is that yields are now higher. So if you buy into a bond fund, your expected return will be much higher than it was just 6 months or a year ago. And if we look at the reasons against buying bonds now, the kryptonite for bonds is inflation. And if inflation stays high for a long period of time, that would be an awful story for buying bonds because it erodes their value over time. And just as recession is good for bonds, if growth surprised on the upside, well, in that case, that would be bad for bonds. So maybe things aren't as bad as we thought for the US economy. Now let's look at the atrocious losses in bond funds in 2022. In this top panel, what I've shown is the US 1-year Treasury yield and the 30-year Treasury yield since 2019. And you can see the broad pattern is that they start off fairly high, they fall very sharply in 2020 with the pandemic, and then gradually in 2022, and then very quickly, yields have risen again. Now, of course, the relationship between yields and prices for bonds and bond funds is an inverse one, so that when yields fall, prices rise, and when yields rise, prices fall. And in this bottom panel, what you can see are the prices of 3 of the largest US ETFs for US Treasuries. Now what I've done is I've got 3 different durations for those funds. So SHY is the black line above me. That's the one that doesn't move up or down much because it's very short duration funds. That just buys treasuries which are in the 1 to 3 year maturity range, and those are very insensitive to yield curve movements. That's why in 2020, that SHY fund only increased very slightly in value. IEF is kind of the belly of the curve, that's the 7 to 10 year range of maturities, and you can see the price of that fund increased a lot more than it did for SHY in 2020. And then finally in red, we've got the really long duration US Treasury fund, which is TLT. And that only buys US Treasuries which mature in 20 years or more. So this is really long duration. It's very sensitive to interest rate movements, which is great when yields are moving down because the price moves up a lot as it did in 2020. However, in 2022, what you can see is everything went into reverse. So the longest duration Treasury fund, TLT, has lost huge amounts of money and SHY has lost least, with IEF somewhere between the two. Now, the other important thing to point out is if you look at the black line here, the short end of the US Treasury curve, that pretty much tracks what the Federal Reserve sets as its monetary policy rate. That's the federal funds rate. So when the Fed raises interest rates, or sometimes a bit before, this 1-year yield will start to rise. And it rises pretty much to be in line with that federal funds rate. Whereas for the longer end of the curve, for the 20 or 30-year part of the curve, that's driven much more by growth expectations, that's GDP growth, but also inflation expectations. So for example, in 2020, when the Fed cut interest rates to 0, the 1-year Treasury rate pretty much tracked it, whereas the 30-year fell because growth expectations fell, inflation also fell, but it fell nowhere near as much as the 1-year rate. And then as growth expectations gradually improved, so did the 30-year yield. And a big part of the yield increases we've seen at the 30-year part of the curve in 2022 are due to inflation rising. If we break down the returns on SHY, IEF, and TLT into year-on-year returns, and that goes back to 2005, you can see SHY here in the top panel, and that really doesn't move around much at all. That's only lost minus 3.4% in 2022 so far, whereas IEF has lost about 12% And TLT has lost a whopping 24% so far in 2022. Now, that's not the biggest fall it's ever had. In 2009, as yields started to rise after the global financial crisis, it lost about 25%. But still, a very big loss for TLT this year. Now, using Robert Shiller's data, we can push back the analysis further, and this takes us back to 1953. Again, we're looking at annual US 10-year Treasury returns, which is roughly equivalent to the IEF fund, which is the intermediate fund that we saw previously. So as of March 2022, which is when I got the last update from Shiller's spreadsheet, 10-year treasuries had lost 20%. Now that is, in fact, the biggest total real return loss for US 10-year treasuries since 1953. Now, to put that into some kind of context, in the bottom panel here, you can see the total real return for the S&P 500 in the same periods. So a really big loss for equity, which is about 40% or maybe 34%, is usually much bigger than it would be for bonds. So this 20% loss is truly catastrophic for a bond fund. And really it's been a perfect storm for US Treasuries because growth expectations have picked up, but also inflation is extremely high. And that's what you can see on this graph. And in 2022, if we go back to a previous time when inflation was this high, we have to go back decades. And we're just looking at the really high inflation period, this kind of double peak in inflation in the mid-1970s and the late 1970s and early 80s. Now, this is the kryptonite for bonds, because if you're receiving a fixed rate of income, then any kind of inflation which is higher than that income will effectively erode any value or any income which you're getting with that bond. So certainly one of the reasons why we had such a huge sell-off in bonds was because of this very high inflation. Before we move on to the reasons for and against holding bonds right now, many of these relationships are the type of thing I discuss all the time in my free weekly market roundup. It's a great way to learn about those relationships, and there's always a funny tweet, usually about a dog, at the end of the email. If you want to learn more about that, just click on the link beside me and in the description beneath me. The first reason for buying bonds is that we might be about to enter a US recession. In this top panel, you can see US CPI inflation, and the blue shaded regions are US recessions. Now remember that inflation is bad for bonds, so when it falls, that's good for bonds. And notice that during a recession, it usually marks the point at which inflation falls from a peak. It happened in 1970. You can see this turning point again, and this was around 1974. Then there was another turning point in 1980, again marked by a recession. And then this strongly disinflationary period, that's when the rate of inflation is falling, was again a US recession. It really is a very consistent pattern, even if inflation starts off very high initially. And then in this bottom panel, you can see the price of oil. Now remember that when its price fell almost to zero in the futures market in 2020, again, that was because of a very sharp recession. Similarly, in 2009, this very rapid fall in the price of oil was due to a US recession, and you can see again that this is a fairly consistent pattern. And the reason for that is that the US is a big user of oil. It has a very large demand for oil. So when US economic activity falls, which is what a recession is, the demand for oil falls, and usually the price will also fall. Now at the moment, there's a big imbalance between supply and demand for oil, because after the lockdowns that we saw during the pandemic, economic activities restarted, the demand for oil has increased, and yet at the same time the supply has fallen. So that's been very inflationary for oil prices and energy prices in particular. But if we do see a US recession, then what we'd expect to see is demand for oil would probably fall, and that would drive down energy prices, and that's also a big driver of US inflation. So if inflation did come down, that would be good news for US bonds. And what we'd see is that bond yields would fall and bond fund prices would rise. And the funds which would gain the most would be those with the greatest duration, like TLT. The second reason for buying bonds now is that yields are higher. Now, roughly speaking, the yield on a bond or a bond fund is roughly the income you receive, both from the coupons on the bond, but also due to the capital gain on the fund. Now, what we can do is look at something called the yield curve. So what we plot here is the yield on bonds of different maturities. So here we've got 1-year US Treasuries all the way up to 30-year US Treasuries. And this is a snapshot about a year ago on June the 23rd. Notice how the short end of the curve is very low. The long end of the curve is relatively high. So what we've got is a pretty steep yield curve. But whatever the maturity of the US Treasury, yields were pretty low across the whole curve. Compare that with what we've got as I make this video, and we've got a pretty flat yield curve and the yields are all higher. So even at the short end of the curve, the yields are now above 3%. That's a very different macro world from the one we found ourselves in just 6 months or even a year ago. Effectively, what that means is that you get a bigger income with your bond funds right now. And gradually, as time passes and the contents of the fund mature and then get replaced, they'll be replaced with bonds which have a higher income, a higher coupon. So the risk reward that you get with US Treasuries pretty much of any maturity right now is much better than it was just a few months ago. There's also more leeway for bond yields to fall because previously, you can see at the shorter end of the curve in particular, there wasn't much room for falls. And some people thought that would constrain the upside on bonds. The situation now is that bond yields have much further to fall, so that means there's more upside for the price of the funds. Now let's look at the reasons why you might not want to have bonds. And the first one is sticky inflation. What do we mean by that? Well, if you look at the components of the CPI basket, this is how the CPI inflation is measured by looking at a broad basket of goods and services which US consumers buy regularly. You can actually decompose it into two groups. Now, some of those items have their prices updated regularly. So those are called flexible price items in this research note from 2010. But some other components actually have a high relative importance, but their prices are infrequently updated. So for example, toddlers apparel has its prices updated very infrequently, as do household furnishings and operations, whereas motor fuel has its price updated very frequently. And the same is true of the price for fresh fruits and vegetables. So what we're going to focus on are the components of the CPI basket which are more predictive of future prices. Because if those components are rising, we'd expect inflation to stay higher for longer. Well, here's the CPI rate of inflation going back to before 1969, just focusing on those sticky components. Now notice what's happened recently in 2021 and 2022 is that sticky price inflation has soared upwards. It's still not as high as it was in the early 1980s, but it's still increasing rapidly. And in fact, the Fed noticed in its June meeting that price pressures have spread to a broad range of goods and services. It's not just about fuel now, it's also spread to the price of services. So if that's the case, inflation could stay higher for much longer than we expect, and that would be a terrible story for bonds. Because remember, they hate high inflation. The second reason why it might not be a good time to buy bonds is that we might get a US growth surprise. Remember at the beginning of the video, we said that the long end of the yield curve was driven by growth expectations. So what I've actually plotted here is US nominal GDP growth, that's not adjusted for inflation, and I've compared it with nominal treasury yields. So GDP growth is in blue and the 20-year yield is in red. And you can see they track each other reasonably well. And this shows data going back to the early 1960s. So for example, as US nominal GDP growth was increasing, so did yields on US 20-year treasuries. And as GDP growth started to tail off, so did the yield on treasuries. So what would happen if growth isn't as bad as people expect? Everyone's talking about a recession in the United States, but what if that doesn't happen? What if growth is actually reasonably good? Well, that would be a really bear case for US treasuries, particularly long-dated ones. If growth was higher than expected, then US yields would rise and bond prices and bond fund prices would fall. So that would be the bear case for bond funds. Now, what you can actually do is to back out what the fair yield would be on US treasuries given a level of GDP growth. So that's what I've done here. I had to smooth US GDP over a 5-year period. I took the rolling 5-year median. And once you do that and build the model, the fair yield that you get for US Treasuries at the 20-year part of the curve is 3.4%, which is very similar to the current yield, which is 3.5%. So if growth did surprise to the upside, then yields would rise, prices would fall, and it would be a bad story for US Treasuries. So what am I doing about that right now? Firstly, I should stress that this is in my fund portfolio, which is a very small percentage of my total capital. And this is where I do all the kind of tactical trades, which usually lose money. Really, the sole purpose of that portfolio is just to keep my hands off the core, where I just have 3 funds, global equity and global bonds. And in that core portfolio, I've simply carried on drip feeding into globally diversified equity. But for the fund portfolio, I do the tactical stuff, which often loses money. And this trade would be no different. Now, one of my big success stories in that portfolio was my commodity fund. So just as the commodity supercycle story was kicking off, after we came out of the pandemic, I bought into this diversified commodity fund, and that fund has risen by about 70%. So this was a rare case when I actually made money in my fund portfolio. Well, I finally sold that fund, and the reason for that is that if we do get a US weak period of growth or even a recession, that's going to reduce demand for commodities, and it'll be bad news for that fund. And in its place, what I'm thinking of doing is buying US Treasuries. I'm not sure which duration to choose at the moment, but I think that's going to be its replacement. And the reasons for that trade are the ones I've listed in this video. In conclusion then, if we do get a US recession or a period of very weak growth, that could be a very good story for US Treasuries. And the reason for that is that if oil prices fall due to reduced demand, then we'd likely also see inflation falling because energy prices have been a big driver of US inflation. And lower inflation would mean that US yields would actually fall as well, and prices would rise. The bear case for US Treasuries is that inflation might be more sticky than we expect. If inflation really is spreading out to other components, particularly services and those sticky components, then it might be around for a long time, and that's a really awful situation for US Treasuries. Or it might be that people are simply too pessimistic about US growth. We might be about to see a resurgence in growth, in which case, again, that would be awful for US Treasuries because yields would rise at the long end of the curve and bond fund prices would fall. Now, if you do see any kind of price crash, if you're a contrarian, you're tempted to rush in and buy the asset because it looks like a bargain. But in the case of US Treasuries, I think there are these fundamental reasons why yields might be too high at the moment. Perhaps people are just too optimistic about US growth. And if we do see a US recession, that would be a great case for buying US Treasuries. Inflation is a problem. And if that does stay high for a long period of time, that is a bear case. But I think that if there was a recession, then probably that would be hugely disinflationary. So we'd expect to see inflation come down too. And remember, that's what the Fed's trying to do, which is reduce demand and push inflation down. So I think there are many reasons why this is looking attractive right now. But as I say, this is my fund portfolio. Don't copy me. And if you are going to do it, only use a tiny bit of capital to do so. Remember, we've got our offer for our free weekly market roundup. If you want to learn more about that and learn about macro and markets, just click on the link beside me and in the description beneath me. And as always, thank you for listening.